I'm reading an article by George Soros. The title is The Global Financial Crisis and Its Aftermath. A Better Beloved Was Possible. It was published around 2009. The crash of 2008. The bankruptcy of Lehman Brothers on Monday, September 15, 2008, was a game-changing event. Until then, whenever the financial system came close to a breakdown, the authorities intervened. This time they did not. The consequences were disastrous. CDS, that is credit default swaps, went through the roof, and the American International Group, AIG, which carried a lot short positions in CDS, was facing imminent default. By the next day, Tuesday, Treasury Secretary Henry Paulson had to reverse himself and come to the rescue of AIG, albeit on extremely punitive terms. But the worst to come. Lehman was one of the main market makers in commercial paper and a major issuer. An independent moneymaker fund held Lehman paper, and since it had no deep pocket to tend to, it had to break the buck. That is, stop redeeming its shares at par. This caused a panic among depositors, and by Thursday, a run on money market funds was still in full swing. The panic spread to the stock market. The Federal Reserve had to extend a guarantee to all money market funds. Short selling of financial stocks was suspended, and the Treasury announced a $700 billion rescue package for the banking system. This provided some temporary relief to the stock market. Paulson's $700 billion rescue package was ill-conceived. More exactly, it was not conceived at all. Strange as it is, the Treasury Secretary was simply not prepared for the consequences of his action when he allowed Lehman Brothers to fail. When the financial system collapsed, he had to rush to the Congress without any clear idea of how he was going to use the money he was asking for, and only a rudimentary concept of setting up something like the Resolution Trust Corporation, which acquired and eventually disposed of the assets of failing savings and loan institutions in the savings and loan crisis of the 1980s. So he asked for total discretion, including immunity from legal challenge. Unsurprisingly, Congress did not give it to him. Several voices, my own included, argued convincingly that the money would be better spent injecting equity into banks rather than taking toxic assets off their hands. Eventually, Secretary Paulson came around to the idea, but he did not execute it properly. I outlined how it should have been done in an article published in the Financial Times on September 14, 2008. Conditions in the financial system continued to deteriorate. The commercial paper market ground to a halt. LIBOR, that is the London Interbank Offered Rate, rose. Swap spreads widened, CDS blew up, and investment banks and other financial institutions without direct access to the Federal Reserve could not get overnight or short-term credit. The Fed had to extend one lifeline after another. It was in this atmosphere that the International Monetary Fund, IMF, held its annual meeting in Washington, starting on October 11, 2008. The European leaders left early and met in Paris on Sunday, October 12. At that meeting, they decided to, in effect, guarantee that no major European financial institutions would be allowed to fail. They could not agree, however, to do it on an inclusive Europe-wide basis. So each country set up its own arrangements. The United States followed suit in short order. These arrangements had unintended adverse side effects all over the world. They brought additional pressure to bear on the countries that could not extend similarly credible guarantees to their financial institutions. Iceland was already in a state of a collapse. The largest bank in Hungary was now subjected to a bear raid, and the currencies and the government bond markets of Hungary and the other Eastern European countries fell precipitously. The same happened to Brazil, Mexico, and the Asian tigers, and to a lesser extent Turkey, South Africa, China, India, Australia, and New Zealand. The euro tanked and the yen soared. The dollar strengthened on a trade-weighted basis. Trade credit in the periphery countries dried up. The precipitous currency moves claimed some victims. Leading exporters in Brazil had gotten into the habit of selling options against their appreciating currency and now became insolvent, precipitating a local mini crash. All these dislocations taken together had a tremendous impact on the behavior and attitudes of consumers, businesses, and financial institutions throughout the world. The financial system had been in crisis since August 2007, but the general public hardly noticed it, and with some exceptions, business carried on as usual. All this changed in the weeks following September 15, 2008. The global economy fell off a cliff, and this became evident as the statistics for October and November began to appear. The wealth effect was enormous. Pension funds, university endowments, and charitable institutions lost anywhere between 20 and 40% of their assets within a couple of months. And that was before the $50 billion Bernard Madoff scandal was exposed. The self-reinforcing recognition that we are facing a deep and long recession, possibly amounting to a depression, has become widespread. The Federal Reserve responded forcefully, slashing the Fed fund rate to practically zero on December 16, 2008, and embarking on quantitative easing. The Obama administration is preparing a 2-year fiscal stimulus package in the $850 billion range and other radical measures. The international response has been more muted. The IMF has approved a new facility that allows peripheral countries in sound financial conditions to borrow up to 5 times their quota without conditionality. But the amounts are puny, and the possibility of a stigma continues to linger. As a result, the facility remains unused. The Fed opened up swap lines with Mexico, Brazil, Korea, and Singapore, but the European Central Bank President Jean-Claude Trichet inveighed against fiscal irresponsibility, and Germany remains adamantly opposed to excessive money creation that may lay the groundwork for inflationary pressures in the future. These divergent attitudes render concerted international action extremely difficult to achieve. They may also cause wide swings in exchange rates. In retrospect, the bankruptcy of Lehman Brothers is comparable to the bank failures that occurred in the 1930s. How could it have been allowed to occur? The responsibility lies squarely with the financial authorities. notably the Treasury and the Federal Reserve. They claim that they lacked the necessary legal powers, but that's a lame excuse. In an emergency, they could and should have done whatever was necessary to prevent the system from collapsing. That is what they have done on other occasions. The fact is that they allowed it to happen. Why? I would draw a distinction between Treasury Secretary Paulson and the Federal Reserve Chairman Ben Bernanke. Paulson was in charge because the Lehman Brothers, as an investment bank, was not under the aegis of the Federal Reserve. In my view, Paulson was reluctant to resort to the use of taxpayers' money because he knew that it would entail increased government control. He was a true market fundamentalist. He believed that the same methods and instruments that got the markets into trouble could be used to get them out of it. This led to his abortive plan to create Super SIV, Special Investment Vehicle, to take over failing SIVs. He subscribed to the doctrine that the markets have greater powers to adjust than any individual participant. Coming 6 months after the Bear Stearns crisis, he must have thought that the markets had had enough notice to prepare for the failure of Lehman Brothers. That's why he had no plan B when the markets broke down. Ben Bernanke was less of an ideologue, but coming from an academic background, the bursting of the super bubble found him unprepared. Originally, he asserted that the housing bubble was an isolated phenomenon that could cause losses up to $100 billion, which could be easily absorbed. He did not realize that the equilibrium theory was fundamentally flawed. As a consequence, he could not anticipate that the various methods and instruments based on the false assumption that prices deviate from theoretical equilibrium in a random manner would fail one after another in short order. But he was a fast learner. When he saw it happening, he responded by drastically lowering interest rates, first in January 2008 and again in December. Unfortunately, his learning process started too late and always lagged behind the actual course of events. That is how the how the situation spun out of control. On a deeper level, the demise of Lehman Brothers conclusively falsifies the efficient market hypothesis. My argument is bound to be controversial, but it raises some very interesting questions. Each of its 3 steps will take the reader to unfamiliar grounds. The first step is to acknowledge that there is a asymmetry between being long or short in the stock markets. Being long means owning a stock. Being short means selling a stock one does not own. Going long has unlimited potential on the upside, but a limited exposure on the downside. Being short is the reverse. The asymmetry manifests itself in the following way. Losing on a long position reduces one's risk exposure, while losing on a short position increases it. As a result, one can be more patient being long and wrong than being a short and wrong. The asymmetry serves to discourage the short selling of stocks. The second step is to understand CDS and to recognize that the CDS market offers a convenient way of shorting bonds. In that market, the risk-reward asymmetry works in the opposite way to stocks. Going short on bonds by buying a CDS contract carries limited risk, but unlimited profit potential. By contrast, selling CDS offers limited profit but practically unlimited risks. The asymmetry encourages speculating on the short side, which in turn exerts a downward pressure on the underlying bonds. When adverse development is expected, the negative effect can become overwhelming because CDS tend to be priced as warrants, not as options. People buy them not because they expect an eventual default, but because they expect the CDS to appreciate in case of adverse developments. No arbitrage can correct the mispricing. That can be clearly seen in the case of a US and the government and the UK government bonds. The actual price of the bonds is much higher than the price implied by CDS. These asymmetries are difficult to reconcile with the efficient market hypothesis. The third step is to take into account reflexivity and recognize that the mispricing of financial instruments can affect the fundamentals that market prices are supposed to reflect. Nowhere is this phenomenon more pronounced than in the case of financial institutions, whose ability to do business is so dependent on confidence and trust. A decline in their share and bond prices can increase their financing costs. That means the bear race on financial institutions can be self-validating, which is in direct contradiction to the efficient market hypothesis. Putting these three considerations together leads to the conclusion that the Lehman Brothers, AIG, and other financial institutions were destroyed by bear race in which the shorting of stocks and the buying of CDS mutually amplified and reinforced each other. The unlimited shorting of stocks was made possible by the abolition of an uptick rule, which would have hindered bear race by allowing short selling only when prices were rising. The unlimited shorting of bonds was facilitated by the CDS market. The two together made a lethal combination. That is what AIG, one of the most successful insurance companies in the world, failed to understand. Its business was selling insurance, and when it saw a serious mispriced risk, it went to town insuring it in the belief that diversifying risk reduces it. It expected to make a fortune in the long run, but it was destroyed in the short run because it did not realize that it was selling not insurance but a warrants for shorting bonds. My argument lends itself to empirical research. The evidence shows that the CDS market is much larger than all the bonds markets put together, having peaked at an amazing $62 trillion nominal amount outstanding. There's only anecdotal evidence that there was some collusion between the people who shorted stocks and bought CDS. But the matter could be further investigated. The prima facie evidence favors the conclusion. This raises some interesting question. What would have happened if the uptick rule had been kept in effect and speculating in CDS had been outlawed? The bankruptcy of Lehman Brothers might have been avoided. But what would have happened to the super bubble? One can only conjecture. My guess is that the super bubble would have been deflated more slowly with less catastrophic results. But the after effects would have lingered longer. It would have resembled a Japanese experience more than what is happening now. What is the proper role of short selling? Undoubtedly, it gives markets greater depth and continuity, making them more resilient. But it is not without dangers. Bear race can be self-validating and ought to be kept under control. If the efficient market hypothesis were valid, there would be a priori reason for not imposing any constraints. As it is, both the uptake rule and allowing short selling only when it is covered by actually borrowed stock are useful pragmatic measures that seem to work well without any clear-cut theoretical justification. What about the credit default swaps? Here, I take a more radical view than most people. The prevailing view is that they ought to be traded on regulated exchanges. I believe they are toxic and should be used only by prescription. They could be allowed to be used to insure actual bonds, but in light of their asymmetric character, not to speculate against countries or companies. CDS are not the only synthetic financial instruments that have proven toxic. The same applies to the slicing and dicing of CDOs, that is collateralized debt obligations, and to the portfolio insurance contracts that caused the stock market crash of 1987, to mention only two instruments that have actually done a lot of damage. The issuance of stock is closely regulated by the SEC. Why not the insurance of derivatives and other synthetic instruments? Most importantly, the role of reflexivity and the asymmetries I have identified ought to prompt a rejection of the efficient market hypothesis and a thorough reconsideration of the regulatory regime. Now that the bankruptcy of Lehman Brothers has had the same shock effect on the behavior of consumers and businesses as the bank failures of the 1930s, the problems facing the Obama administration are at least twice as great as those of the confronted President Franklin Roosevelt. This can be seen from a simple calculation. Total credit outstanding was 160% of GDP in 1929, and it rose to 260% in 1932 due to the accumulation of debt and the decline of GDP. We entered into the crash of 2008 at 365%, which is bound to rise to 500% or more by the time the full effect is felt. And this calculation does not take into account of the pervasive use of derivatives, which was absent in the 1930s, but immensely complicates the current situation. The nominal amount of CDS contracts outstanding is more than 4 times the GDP. On the positive side, we have the experience of the 1930s and the prescriptions of John Maynard Keynes to draw on. His general theory of employment, interest, and money was published only in 1936. We have it at our disposal from the outside. That's the end of this part.